Okay, so I'm going to flash the emergency numbers one more time before we get started. I'm just going to let those sit there in case we need them for any reason. But today, we're just going to start getting in a little bit more into that first phase of planning that we talked about. As you know, last time we spoke about how we like to pretty much boil the planning process, just the whole financial process, down into three phases. One where we do your planning now, we do sort of your strategizing, and we create the investment product, the investment portfolio that supports that, and then we make sure we maintain that plan throughout time. So today we're going to dive a little bit more into the first section of that, what that looks like, what that actually entails, and the things that you're going to be evaluating of your current situation, of your current plan, before we dive into all the investments and all of the fun stuff later. So here's another little diagram of how we break out that three-phase process. So we start with our basic financial planning, sort of laying the foundation, checking in on the different stuff that you're doing, making sure that you are actually positive in your cash flow, or at least even. Make sure that your insurance coverages are enough. They're covering your at-risk assets. Make sure that your estate planning is at least doing the minimal of what you want it to do, even if it's not perfect, but making sure that assets are going where they need to and they're protected. And then making sure that we really just are not throwing away money at taxes. It's hard for us to get away from taxes. We know that only two things in life are certain: death and taxes. But there are things that we can do at least to make the journey along the way a little bit more efficient and not just throw money out the window when we don't have to. And then we'll move on to creating an investment portfolio that supports that and maintaining the plan so that you stay on track for the rest of your days. So phase one is what we like to call the diagnostics. And the reason that we call it that is mostly because it's just, you're really just doing a checkup, or you're taking your car to the mechanic and being like, am I doing okay? Is everything going all right here? Make sure the doc looks at you and goes, it looks like everything's fine. Your cholesterol's a little bit high. Maybe your expense ratio is a little high, but everything's all right. And you're not dying tomorrow. You know, we would just want to make sure that the red flags are not so big that you have a huge risk within the next couple years. So what we're going to look at first, and this is one that you probably have done yourself. I mean, a lot of people, the budget is what they really have down, but we'll go over it anyway, just to make sure, in case there's anything you haven't thought of. So what we like to think about is look at the money in and money out today and be able to do at least some soft projections moving forward. Because if you don't have a proper expectation, it's really hard to make a proper plan. If I'm looking at an investment account and I know I need to generate 3-4% of income, but I chuck it all into the S&P 500 that only shoots off 1 to 1.5% of yield, I'm going to have to sell off those securities to fund my distributions to pay things with. And whereas I could have made another portfolio where I don't touch the principal anyway. It's really important to understand what the expectations are so that we can actually put them into a mathematical equation that shoots out a proper plan. So with concrete numbers, we can way more easily calculate the needed assets. So this also helps us to where if we have a need and we have a large pile of assets, it helps us section off our assets for each individual need. If I have an income need, if I have a need for a beneficiary where I just want growth, it's much easier to segment those needs from the big pile of assets, or create different vehicles and understand that what we have sectioned off is the mathematical amount to help us support that need. So the process is way more important for midlife investors, but it's still really important for those living on investment distributions, because oftentimes when you get to living on investment distributions, Social Security, pensions, your income starts getting a little fixed. You're pretty comfortable with where you're at. That makes sense. But it's really, really important for those in midlife so that they can really understand that once they make it to that retirement stage, or once they make it to a point where some income drops off and things change, that we're actually prepared for that and we're not just fumbling into that moving forward. Yes? No. There we go. Yep. Okay. So most of you should already have a good grasp on your budget. I really would hope so at this point. But knowing the specifics makes the rest of this planning much easier. Really knowing what your income and expenses are helps a lot. So Obviously, you want to look at your different sources of income. For a lot of people in early life and midlife, that's wages and employment. You might have some self-employment or contracted work, but then you're also getting to things like Social Security payments, pension plans, annuity payments, or investment distributions. And this can include things like RMDs, or if you're just taking off interest or income out of a taxable account, all the different places where the money comes in, just tally that up. And then for your expenses, obviously, look at the common things like housing, healthcare, groceries, utilities, all the stuff you know. And we actually created a sheet for our clients that we passed out, which is our income and expenses sheet. It has a place where you could put your current expenses as well as put projected expenses. Oftentimes, I have clients do this when they are asking for a portfolio to provide living expenses, because it's really important for me to know what their expectations are so that I don't put them in a portfolio that doesn't suit their needs, or they just have some unreasonable expectation that there's absolutely no way I'm going to be able to fulfill. I want to make sure that expectations are clear and actually reasonable. Oh, sorry. So there's both a current and a projected section on the income and expenses sheet. So projected just means you're kind of looking forward and saying, this is what I expect my expenses to be in the future if they're looking to change. So for a lot of you, they might not be looking to change, but you might be, I mean, even if you're considering not owning a rental property anymore, that's an income change. So it's an important thing to factor into the plan. So for future expense planning, based on your age, your health, the pension size, investments, and everything else, it's really important to understand in each stage of life, for each year of life, moving forward, what income and expenses you're going to have. Because a lot of the times, again, like I mentioned, people like to use their investment accounts for income, for distributions, to fill up any deficit. So oftentimes maybe you'll have your Social Security and your pension, and there's just this little bit of extra that's not covered by any other income since retirement or any other change. So you like to make up that little deficit with investment distributions, or RMDs can kick in, but it's important to understand moving forward, how's that going to change? Am I going to need more of my investment distributions to cover an income deficit, or am I going to need less and I could shift them towards another goal? So using a couple really basic financial calculators, we can solve for a lot of different needs. I briefly mentioned time value of money last time, and we'll just I won't take you through the actual calculation of it or anything, but I'll show you a couple examples of how it resolves itself. So in the time value of money calculation, there are 5 different pieces that really help generate the result. So you have current capital, or you could call that as present value, so like the today's value of the dollars, future capital or future value, which is the value in the future of the dollars, the investment return or interest, so that's just kind of what those dollars are going to earn on average year over year, so that's an annualized number. Time horizon, which is just over how long the calculation is taking place, how many periods. You could call this, for the most part, it's years, but you can also work with these numbers and make them quarters or months, really whatever, but the standard is years. And then payments in and out, super similar to a lot of everything else. It's a yearly number, or it's for each period, how much capital is coming in and out of that account. So putting all those together, we can help create a calculation that gives us an estimation for any of these. You essentially put in 4 of the 5, and then it will spit you out the 5th one. So if you're looking to figure out how much money do I need today to satisfy this level of income with this level of return that I see in my portfolio over this period of time, you can plot that in there, and then it will give you how much you need. Or you can say, put in every value except for time horizon, and then you see how long would this portfolio actually last me, distributing out this amount of dollars with this amount of return. So we'll look at a couple of examples of what that actually looks like. So the first scenario is you have an investor that wants to generate $50,000 a year income stream over a 20-year period. And at the end of the 20 years, we're assuming that the assets get drawn down to 0. So this income will include the returns that are generated, as well as pulling out money from the account, so that over time, the account value drops and finally hits 0. This would be somebody where they don't have any beneficiaries. There's nobody that this money is going to, so we just want to spend it over the period of time. So if we say that,
Some people do it as a gap year for early retirement, and then they can wait till they're 70. So they have a shorter time frame saying, I might retire at 60, but I don't want to draw that till I'm 70. So he runs a calculation saying you can do this for 10 years and not using the Social Security until you're 70.
Yeah.
So whatever else happens at the end.
It's not necessarily death, it might be another income
right,
start.
Yeah.
Or we have a big tall building, we'll show you where you can jump off.
I would only need a short building.
okay, so if we look at this portfolio and we assume an average return of 7%, this is not numbers pulled from anywhere. This is just deciding 7% because a lot of people understand that as a number. So if we assume an annualized average return of 7% over a 20-year period with cash outflows of $50,000 and a future value of $0, that's 4 of those 5 different pieces, we then get a calculation of roughly $530,000. And a lot of that just comes out of the principal coming out of the account and maintaining that all the way towards the end. So in the next scenario, an investor, yes. Yeah.
What's that? The investor needs 530,000 in the current.
Yeah, as the current value today. So if you were to start with a lump sum, this is what you'd need, assuming that nothing extra is going in, we're just taking out $50,000 a year, we land up on this number. Yes. So in the next scenario, we're just going to solve for a different one of the variables. So like you'll see, as we move around, you just are switching out which one you're calculating for and using the other pieces. So now if we're looking at the same person who wants to generate that $530,000, maybe we're 10 years away from that. And again, we're not thinking about inflation right now, but let's say we need that $530,000 in 10 years so that we can begin that income stream. And we're starting with a $150,000 portfolio, but for some reason, this person doesn't want to add anything to their account. And they want to know, well, okay, what can I invest in to make this happen? Well, if we solve for that, we end up requiring a 13.5% annualized average return, which, if you know much about average returns, is really high and oftentimes not really achievable. And the other thing to remember, this is kind of a spin-off of this question, but there's another risk that's really important when you get into assets that have this kind of volatility, and it's something that a lot of people don't like to think about. A lot of people who really like to just stick it in index funds and forget about it, or take really big distributions, and it's called sequence of returns risk. Sequence of returns risk is really important because it's the risk that not every single return is going to be the same year over year. It's very possible that every single year has been amazing, and then the very last year is the worst one out of the series. Or it could be great and then horrible and then great and then horrible and horrible and horrible. So a lot of those things can be different, and the average return might still be this, but the last year's return might have been a negative 60%, and it still averages out. So understanding that when you're at this level of risk for this return, it's probably going to be really hard to get that anyway. And you have to exist in a period of 10 years that really favors this asset class for you to get a positive series of returns over and over and over again. So being able to use numbers like this and sit with a client and go, it's kind of unreasonable for me to generate you this level of return year over year, would be able to help them understand that we're just not able to satisfy this goal, and maybe we need to change the operation of this. So what you would probably end up recommending for somebody like this is go, just make some kind of contribution every year. You got to add to this. You got to figure out ways to shift money from other places into here, because in order to generate that $530,000, you need both a strong return and you need to be adding capital. So that's when we would start messing with those calculations. So moving on, the next thing that's really important is the insurance diagnostic. This is one that, for the most part, I would say people tend to have 60 to 70% covered. They're usually pretty well off, but they might be missing a couple key things. So evaluating your insurance coverages and ensuring that the totality of assets are protected is really important. This can kind of mesh into estate planning a little bit, because there are a couple different ways that assets can be protected, but we'll focus on the insurance perspective from here. So if you have a plan, if you have an idea that I'm going to generate this income stream then, or I'm going to leave these assets here, or whatever the case may be, whatever the objective is, it will have a giant reduction in probability of success if the assets are depleted from a suit or a major unexpected expense. So you can think what insurance is good for is for low frequency, high severity risk. That's why we use it. It's really important. That's why we don't really ever think we're going to get in a car crash when we go out and drive, but we're really happy if we have strong coverage when we do, because that's not something that we want to pay out of pocket for. We would rather spread the premiums over the lifetime of the car or whatever it is, and then have the insurance company foot that bill and they take care of the risk, because that's the whole thing that they manage. Same thing if you end up with somebody getting hurt on your property and now suddenly they need medical expenses paid and they're going to sue you, even if they're your friend, it's okay, friends can sue you too. But if your liability insurance doesn't cover the totality of their cost, you are responsible for the rest of that bill. It doesn't just go away. It's up to you now to come up with the assets to pay for that. So making sure that we have coverage that extends, that would cover you in that scenario where all of your assets are covered, that's important. So I'll kind of show it with some diagrams here. So we've got this big circle, and you can imagine this as all of your assets. We're talking real estate, checking accounts, investment accounts, everything you got. All of that is sitting here in this pie. Now, a lot of people are in this situation where they've got most of it covered by insurance. Their cars, a strong amount of their house, maybe they've got some other liability insurance that can cover other things, but we've got this really big sort of open part of the circle. And a lot of times that will include things like brokerage accounts, individual accounts, joint accounts, trust, a lot of different things. So this could be vulnerable depending on what kind of estate planning structure you have and what kind of how the assets are owned. So what can happen is when these low frequency, high severity risks come into play, they can start eating away at those protected assets. And most of the time when people make a plan, they include all of those assets, not just the little circle that's covered by insurance. They include everything in their plan. And if we're looking at a plan where I have 100% of my assets and it's going to do this thing and it's going to fulfill that need, it's going to pay for this expense, and then suddenly your assets drop by 20 to 30%, it's possible that a lot of those needs don't get fulfilled. A beneficiary doesn't get what you wanted to leave them. You can't supplement income for the rest of your life. A lot of these things are really important to make sure that the assets remain. Yes. We'll talk about that in just a second. So what we want is a really good connection between your assets and your insurance. We want all of the assets that you own to be covered by insurance. So we'll look at a whole bunch of different insurance types right here. So you've got the ones that are common, that you understand, that everybody hears about. Your medical expense, make sure that you know what your deductible is, your exclusions, your copays, understanding that so you can really kind of make sure you get the right policy for you. Disability insurance, for a lot of people, especially closer to my age, that's really important because a loss of income could be really bad if you don't have assets to pay for it. Long-term care is important. Some people like to self-insure, and that's fine if you've got the assets for it and you're willing to give that up there, but long-term care expenses can be a lot. I mean, we have a client that we look at and it's $20,000 a month. Yeah, $20,000 a month for her in-home care every month.
To stay home and have your own caregiver.
But like we looked at before, the average for a single bed facility was $6,500 a month still. That's still like the median income in the country. So that's really important for us to be able to insure against, because if we have, again, I mean, that cost was more than that $50,000 income stream. And for 20 years, that was $530,000. So you got to look at that also and be able to look at the cost of long-term care, how much of your assets that's going to eat away before you eventually pass, and just how is that going to affect your plan moving forward. Life insurance, again, for younger people is very important, but for some people it can be an estate planning tool. Homeowners insurance is also incredibly important because it's part of that liability insurance. Like I said, if there's an injury on your property, you're responsible for comping them for that pain and that damage. Auto insurance, making sure that we have the maximum liability in everything is really important so that if we're in an accident, we actually get everything covered. Yes. Yeah, so if you actually set up a proper irrevocable trust and you make sure that you kind of have that arm's length treatment, that is going to be protected. But what I will say is something that changed in 2023 that I did not realize changed until just a little bit ago is what we talk about a lot. This is not an insurance particular conversation, but we like to talk about step up basis a lot. So if you pass and you leave assets to somebody, those will step up in value, and the basis of their asset will be whatever the fair market value was when you died, or the alternate valuation date if you select that. We'll talk about that later. But if you put assets into an irrevocable trust, it no longer gets that step up in basis. So that's an interesting thing to sort of consider, is because the way I've been talking about it since we started having this conversation in our office is they're kind of treating the irrevocable trust like a person that never dies. So instead of you passing and it's your assets in the irrevocable trust and then somebody inherits them, it's more like you gave a gift to the trust and now the trust is giving a gift to the kid. Right? So that's something interesting that I just recently learned about. And I was surprised there wasn't more of a commotion over that in conversations, but yeah, so that's something interesting. Now, I want to go back to the FDIC thing for just a second, because I think what's important to think about there is that's going to be really similar to a lot of our investment risk conversations, because I would be, personally, if I were concerned about that, I would really be making sure that I bank with institutions that have a much lower chance of actually going under versus, like I would want to be with big banks. I want to be with people who buy their own insurance, not like small regional banks or like small things that could have a bank run done on them and now suddenly there's no assets to pull from. So I would just be looking at maybe who has really, really strong history and just looking back through time and seeing who's weathered these storms the best. And I'd be keeping my assets there if you're concerned about FDIC dropping. Sure, absolutely. Yeah. I mean, again, it's hard to predict a lot of these things because oftentimes we get in those situations, some group of people just kind of get left to figure it out, and then some other group gets bailed out and everything's okay. And it just kind of, it makes me think of like 2008, where all of this crazy stuff happened and one guy got arrested. Like the entire economy was trashed for like 6 years after that, and one person went to jail.
Right thing though, the survival class is here, because if you didn't have FDIC, you might not want to have all your money in a bank. You might want to have it in Treasury direct T-bills or corporate bonds or AAA rated other places. Fortunately, unfortunately, I don't know, but the more that you learn, the more you can prepare for the changes.
I put most of my money into my brokerage account. I leave the minimum in my bank account for paid expenses. Is that a good idea?
Well, for the most part, if it's a big like Charles Schwab or Fidelity or somebody, because they have multi-millions of dollars of additional coverage. But if you want a safe place, for the most part, treasurydirect.org, you have that.
Yeah.
He might talk, but he'll talk.
Yeah, so I would not be super concerned if I'm at a big brokerage firm, because like you mentioned, they've got billions and billions of dollars of insurance on these sorts of things. So there are people that would pay that out. And there are a lot of cash equivalent sort of things that you can have in your brokerage account. I know that Charles Schwab actually has a checking account that links directly to the brokerage account, and you can just transfer money back and forth really easily. So that would be a solution that I would probably be comfortable with if you're not super comfortable leaving your assets in something with FDIC that's kind of up in the air, if that's what you think is going to be happening. So I would definitely be considering cash and cash equivalents. Plus, you'll get better yields anyway. You'll get better interest in something like a money market fund than just sitting in a savings account, getting paid 0.1%, and then also losing FDIC. A couple things put together. Sure. Yeah, they've actually been pretty competitive for a little while now. It's been, the spreads are pretty tight across the board for all different types of income assets. So yeah, they're definitely worth looking at. And just, I mean, I see that a lot. That's a big conversation, is that spreads everywhere are really thin. You're not getting a lot by going anywhere else besides short-term treasuries and CDs. It's just not really worth it to increase the other kinds of risks, except for,
I wouldn't.
you still pay federal tax, you don't pay state tax on T-bills. Yeah. But you can also go for something like ultra short municipal bonds. So I have, there's a fund that I like. It's a JP Morgan fund. I think it's JMST. I think that's the ticker. Super short term municipal bonds if you want tax-free income. So that's pretty great. There's a couple other ones. I think Vanguard has a super short term one too. I forget what the ticker is.
I don't have any California and federal tax rate, ultra short term. We like short term because bonds can get hurt. But if you're worried, just go to treasurydirect.org, control your own money. Yeah, what do you do?
Yeah.
It's a part of the new setup.
We're talking about the treasury, right?
Treasury, yeah.
Yeah, it's not hard, but I mean, it's pretty simple to use. You know, it's better than the secondary market for brokers.
Right, exactly.
Because you're dealing directly with the federal government. Exactly. You don't have to worry about fees and the difference in prices from, because you're buying the secondary market.
And there's state tax rate lease, and you can get, you can liquidate.
Yes. It completely varies. You can check rates pretty frequently. Yeah, you can check rates by day, but they'll change. I think, I don't remember what the last quotes were like. Yields are like, well,
Treasury bonds, I do like maybe 2-3 months, but they're
Yeah.
like 4.1.
Yeah.
okay, yeah, 4.1. Yeah, they probably between 4 and 4.5 is probably where I'm seeing a lot of stuff. Yeah.
The CDs.
Oh, okay. Possibly.
There, but it's gonna mature. Savings accounts, I have a savings account with US Bank.
Yeah, so it looks like the 3-month right now is sitting at 4.31, down 33 basis points for the day. So yeah, a US 3-month.
Yeah, I mean, not to say that treasuries are safer than the bank insurance, but at the same time, that's the last thing maybe they would affect.
Yeah. And that's another reason why you could even make a really good diversified cash account and a brokerage account using things like short-term municipal bonds, short-term government bonds, short-term corporate bonds, money market funds. You can make a really good cash vehicle spread around those different things if you think there's risk there. So we can talk a lot more about that when we get into the investment side of things. So after all of that, a couple key takeaways that we want to think of when we're looking at all of this insurance planning is we want to make sure that we maximize coverage on policies where it's reasonable, where if you can manage the cash flow, the protection is really, really a good thing to help you sleep at night. Because again, your plan can really suffer a lot if a big low frequency, high severity risk hits you and now suddenly your assets drop by a huge amount. So it's important to pay attention to that and cover all the remaining assets with an umbrella policy. So basically what you want to think about is if you've got, say, $2 million in assets, and if you look at all your different insurance policies and you see it covers, let's say we're covering $1 million, and maybe your IRA is 500,000, so we don't need to consider that because it's protected. Now we've got this $500,000 deficit. We want to make sure that we increase our liability coverage with an umbrella policy to capture all of those assets in there, so that if we get into a situation of a lawsuit or some sort of claim or other big thing, that can get taken out of the umbrella policy and not out of our assets. So, so a lot of so if you just hook up with an insurance agent, they'll be able to point you in the right direction. So yeah, they will definitely be able to help you out.
I'm not gonna try to talk you out of it because they don't get much commission on it and it's not worth their time. Right? And the odds of them, of you collecting are low, but don't let them talk you out of it. It's better to say, yeah.
Is it gonna be, say, as expensive as insuring your $500,000 home or?
I have a $5 million umbrella policy and I think it's like $1,200 a year. it's definitely worth it versus what you can lose, right?
Now, does that cover all your assets?
All my personal things, I have a different umbrella for my LLC and properties.
Yeah.
Because we have a saying, is that the best that you can ever hope for from insurance was that it was the worst investment you ever had, right? So you just buy it and it's like having a bodyguard for the health.
Yeah, exactly. Okay.
Sure.
Absolutely.
Yeah, like I said, one, we hear it advertised, something select insurance quote. You get one online that's not tied to agents calling you and stuff. Insurance selector, insurance quote.
Yeah, and so then you can also consider how life insurance could fit into your strategy. Usually this is important for breadwinners and big income earners because you want to make sure you fulfill a loss of income. But if you've got a just ridiculously large estate, I would assume that this is not going to be many people's problem in here, but if you've got an estate of $15, $20 million, there might be some estate tax strategies that a life insurance policy would be helpful for circumventing because, as we know, life insurance proceeds are tax-free. So if you can use that to pay for an estate tax bill, that can save you a little bit of money on assets being dropped when doing estate planning. Speaking of estate planning, we'll talk a little bit about the estate planning diagnostic as well, and the couple things that you want to really make sure that you look at and nail down in your plan, in your situation. So having a will, obviously, super important, really easy to do. You can do it online in 5 minutes. So if you don't have it done, or your kids don't have it done, or your grandkids don't have it done, get them to just make it happen. It's really useful for a small estate. So if you got a really small estate, we mentioned last time there is a small estate affidavit, which will let you not go through the whole probate process if it's under a certain dollar amount. Forget what that is, but it's also, wills are great for collecting sort of miscellaneous personal property. So things like if you don't have an asset with a title or just things around the house that you want to go in certain directions, wills are great for that, to sort of just catch up any of the little things that aren't specifically designated in any other documents. Now, trusts are where we get to having a larger estate or we have much more specific instruction. The other thing that's really useful about a trust is if you have something like a revocable trust and you have your instructions for how you want beneficiaries to receive assets in the trust, you can look at all your other accounts and say, send this to the trust when I pass, rather than saying, send the IRA to this guy, send the individual to that guy, leave the life insurance policies to her, and you don't have to do all of this separate planning. You can leave all of it to the same place, the same entity with the trust, and then let the trust figure out how to disperse the assets once they've all collected. So that's pretty useful. Yeah. Yes.
Irrevocable trust. When properties on the grantor, properties on the revocable trust.
Right.
I'm getting ready to sell it.
Mhm.
And I'm thinking about, removing the revocable trust for tax purposes. Is that a good idea?
It kind of depends.
What is the tax?
Yeah.
Trust tax, capital gains on the trust is highest, it's like 34%, right?
After you die, if the trust inherits everything.
I'm doing it all
I'm not aware of any better tax treatment on a living trust.
Yeah, because it should basically just be passed through, right?
Yes, it
Yeah.
has- One, I would keep it in the name of the trust and check with your insurance agent, make sure the trust is listed as an additional insured for the property. You and the trust, and then in the name of the trust, it's your tax ID number, so it doesn't really matter. You get all the benefits of selling your house. You get the cost basis plus 250 to 500 exclusion.
Yeah.
As far as capital gains goes, then if I was, the tax on the trust is the same as income tax?
Correct.
Because they're not taxing the trust while you're alive. If it's a revocable trust, it's you. And the trust really is there floating around for you to die. Now it kicks in and everything goes that direction.
So I shouldn't remove it out of it.
Yeah, I wouldn't worry about it.
No,
Check with your accountant.
it's really more of like it's kind of more like having a map versus really anything else. It just says go here, make this go here. It's more of an organizational thing for a revocable trust because you don't. Sure.
Sell property, you're gonna have to take it out of the trust. As the buyer, you can't sell the trust to a property to a buyer that's under a trust. So I'm gonna have to get rid of that, I've gotta terminate that irrevocable trust in order to sell that property, right?
No. No, you don't.
So.
No. Yeah.
Like, so. But in your case, it's under your social security number. Now, on the reverse, if you were to own your property and wanted to refinance, they sometimes make you put it in your name, refinance it, and put it back in the trust.
Okay.
Yeah, no, you're okay.
Yeah, you're totally fine.
Your trust, you own it. Title on the house, if the contractor has lien your property, whether it's in your name or the trust, it doesn't matter. So if it passes.
That's good news.
There you go.
Oh, my goodness.
Yeah, I'm a little confused. So let's say we've got four kinds of assets. We've got
Mhm.
banking.
Mhm.
Got property.
Yep.
Brokerage and
Sure.
IRA.
Okay. Yeah. Very common mix.
Should they all be going to the trust, or are there some of them that should be going, having this, what is it, TOD?
Transfer upon death. So,
They-
okay. So let me clear up a couple things there. A transfer on death is like for an account that doesn't already have a beneficiary designation, you're creating one. So you're adding it on to the account so that it can pass somewhere. So if I've got an individual account, it's just an individual account. There's nobody named as a beneficiary on it. I'm going to attach a transfer on death designation to say, when I die, immediately send this here instead of attempt to include it in my estate and process it that way. It's just saying, I want it to go directly over there instead of hang out in my estate and get managed however that's directed.
We have some couples that have trust together, but they have separate kids. So one of them says, I'm putting this in transfer upon death to go to my kid, and it excludes it from the trust. So normally, if you have a trust, most of your non-retirement plans would go into the name of the trust. But if you don't have the time, or you just want to exclude it, then one can do that.
I don't have, anything in the trust except the property. Like 401k IRAs are not involved in the trust.
Those would, they have to be in your name, and then the beneficiary could be the trust, but then it needs to be passed on to a person. Usually better to have an actual person as the beneficiary, unless you have a trust that says we can swipe it over here and put it in somebody's name.
That was my question about the IRA. You're talking about IRAs, right?
Yes.
Regular or Roth.
Correct.
Those don't go to the trust.
Okay, so they are not titled in the name of the trust. They are in your name
Yeah.
until death. And then if you put the trust as a beneficiary, those assets move to the trust, usually so that the trust can direct where everything goes. So one of the things that is important to understand is when you have assets that are taxable coming out, 401ks, IRAs, and the like, maybe some annuities. If you have assets that are taxable coming out, you want to be careful when you put them in the trust, because oftentimes if you put them in the trust and then they stay there, one, they'll have an accelerated withdrawal schedule, so they'll have to come out faster than they would if they just went to a person. So they might have to come out over 5 years or 1 year, whatever the ridiculously short time frame is. And then also trusts pay their own income tax, which is higher than anybody else's tax. It's super high. It's like 40%. And it's like teeny tiny little tax brackets where it's like, oh, that seems all right, but it's for $5,000 of income and then immediately jumps to some ridiculous tax bracket. So if you have IRAs and 401ks, oftentimes what you'll do is called a conduit trust, where the account passes to the trust. The trust is the sole beneficiary of the IRA. So the IRA goes to one person and that's the trust. And then the trust says, spread these assets to those 4 beneficiaries. So as soon as the income comes in, there's like a tiny little time period it can sit there, get sent out, no trust taxes, and then the beneficiaries pay the taxes instead. So they pay it at their tax rate versus the trust's tax rate, which is much higher. So that's the thing to consider. So the reason for that is because it's usually better for the people handling it, like the administrative staff, because what happens is if you take one IRA and you want to split it up between a bunch of people, that has to get re-registered into multiple different accounts that then get distributed. So instead of doing that, all of the assets would go to one place and then get sent out. So additionally, you wouldn't have a bunch of IRAs over here and then a bunch of other types of accounts. It would all come from the same place organizationally. So instead of having multiple accounts everywhere, you have one account with instructions for each bit of income that gets passed out. So it's all in one place and one trustee manages that and makes sure that everything happens properly.
Yeah, the main reason you do that is a lot less that the trust is between you and the beneficiary. So the trust says, yes, pass this on to the beneficiaries, except Susie, she didn't give her money. So set up a legacy IRA and then only give her money.
It's for the control. It's
Yeah.
So that I only have one beneficiary, I only have one daughter, and so it seems to me that that would be just,
Yeah.
you know, it'd be more logical to just put
Sure.
her as the beneficiary.
Yeah.
But then if she, God forbid, was not alive when I died, then that would be a reason to have a trust, because I had this and then.
Yeah.
Yeah, or
Correct. Right. So you can have either a contingent beneficiary on the IRA, you can have a lot of contingent beneficiaries if you want. You can go this person first, then this one, then this one, then this one, then this one, and you can have a really long list. I don't know if there's a maximum for that, but you can do that, or you can create some sort of instructions in the trust that do a similar thing. So it's really just kind of an organizational thing where if you do it in the trust, you only got to do it the one time versus doing that for every single other account you've got over and over and over again.
Yeah, you
Yeah.
get variations. I have a legacy IRA trust, so if I die, my money goes to the legacy IRA trust for the benefit of. But the trustee then distributes it over 10 years, doesn't just give the person all. So if you want to control it, then make sure it goes to the trust, but it's gotta be an updated trust, and then it goes in the directions that the trust said. But if you have a beneficiary that just wanted to get the money outright, just have them as a beneficiary and make sure you have a contingent.
Yeah, that's one thing I actually just thought of is if you want to control the schedule of the distributions.
Yeah.
So when somebody inherits an IRA, they have over 10 years that they are required to take it out, but they can also just take it all out in the first year if they want to, or they can wait and take it all out in the 10th year. So if you want to require that it gets split up evenly over 10 years, then you can set that in the trust, and the trust will wait and make sure it distributes per that schedule versus allowing them to have control over when the assets get received. So that's another thing. So yes. So if assets stay within a trust, the trust will pay taxes if it's like an IRA distribution. So if you take an IRA distribution, you're going to pay taxes at your current tax rate, right? Same thing for a beneficiary. If they receive an IRA and they take money out, that is as if it were a job income, it gets taxed at their highest marginal tax rate. A trust, if the money comes out of the IRA and stays there and does not immediately pass to a beneficiary, it now gets taxed at the trust's tax rate because the trust is a separate entity. It's like a different person. So the trust will pay taxes on that income first. Then it will get sent out later whenever that happens. Verbiage is, but the general term in the industry is a conduit trust. So it's something along the lines of when this income is received, is immediately distributed to X, right? So it's just making sure that you are saying all of the income that comes from the IRA just instantly goes out as soon as is reasonable. And I'm sure there's like some short time frame. Yeah. So yes.
Had the trust done last year, and I think they put I only have 1 year also, so it's not like.
Right.
But I think they put everything in it, like my annuity and my bank accounts and everything. So does that mean this year I'm taking my annuity? So does that mean this year I'm going to tax more on it? Than
So again, that depends. There's two types of trust, revocable and irrevocable. So if you have a revocable trust, it's still like it's just you. It's more of an organizational thing and a future planning. So if you have a revocable trust, that's still under your social security number. There's no new entity. The money's not out somewhere else. And also, if the money gets spent quickly from an irrevocable trust, it's not going to get taxed at a higher rate. But yeah, I would assume that you're working with a revocable trust where it's still your tax ID number, so it's still going to get taxed at your rate, not a trust. The main thing with that is when you have an irrevocable trust, after the death, and taxable assets now go in rather than just like if you have an asset that the basis is close, if there's not gains or it's not a taxable thing, it's not going to pay any taxes just like you wouldn't. But if you have an IRA distribute out where all of that is taxable and it stays in the irrevocable trust for a certain period of time, then it becomes taxed at the trust rate. So
Yeah, in your case, the retirement plans, IRAs, 401k, whatever, probably it's just one. And then a beneficiary, so they get the 10-year stretch, or if you're not sure you trust them, then it could go to the trust, and then the trustee decides who's gonna get these IRAs. They set up a beneficiary IRA, and they have 10 years to get the money.
Okay, coming back to umbrella
Yeah.
insurance now, to calculate that, you should include, I mean, you've got the max on your, phone, okay? Now, the coverage above that, and your assets above that are, you know, include your 401ks, your IRAs, a pension plan, bank
Yeah.
accounts. You should add up the value of all those assets.
So you should add up the value of all assets that are vulnerable to a claim. So a 401k is not going to be vulnerable. IRA is kind of wishy-washy. Most of it will not be vulnerable, but it's like the state does a little calculation of how much of this do you actually need for your retirement. So an IRA is kind of one of those things where you probably don't really need to include it realistically, but there's kind of a chance that you could. Pension plans, yeah, 401k, you wouldn't worry about it. It's safe based under ERISA, which is the employer protection. So that's not going to be vulnerable to creditors. So we're mainly talking about things that are just straight up in your name that are outside of retirement plans or outside of irrevocable trust or trusts for your benefit, all that sort of stuff. Really just those individual brokerage accounts, revocable trust accounts, that sort of stuff. Yes, so any qualified retirement plan will be protected. Yes. Yeah. Please continue. Mhm. Yes.
But what if you take your money out of those and put it into a regular IRA brokerage account, then it's not protected?
Okay. So it depends what state you're in. Yes. So in California, as long as you don't commingle it with other existing IRAs, they receive equivalent protection as the 401ks and 403bs. The California state courts actually determined that they are fully protected as long as you rolled it over straight from a qualified plan into an IRA. Yes, rollover IRAs are safe.
For after retirement, so it's nothing else going in,
Yeah.
so then it's pure.
Yeah.
And then it's
Yeah, so basically what you don't want to do is have a traditional IRA and then roll a 401k into that, because then it gets messy and they have to calculate which part was which, and it just, you know, the earnings, you have to attribute what to what dollars. So that's why you want to keep it separate, and you'll see instead of IRA, you'll see IRRL, and that's your rollover IRA. That's safe. You want to keep that separate so that you maintain that creditor protection. That's California creditor protection.
about this protection in case you were ever sued.
Right. Yeah. There's just something where there's some sort of claim and they need to take cash from you. They can't go after those assets. Exactly. Okay, so let's see. We just talked about trust, and we did just talk about beneficiary designations as well. So that's kind of what all that is. You got your transfer on death, insurance policies, IRAs, 401ks. That's all just making sure that in the event that I die, this is where that money is going. So make sure you have those set up. Whether they go to your revocable trust, that's totally fine. That's often what we recommend for making things easy anyway, or just making sure that you have somebody for all of those. And it's pretty important to also have contingents, particularly if your spouse is your beneficiary. So if your spouse is your beneficiary, similar in age, similar in longevity risk and all that sort of stuff, make sure you have a contingent beneficiary, which that could also be the revocable trust. So just making sure that we have backups in case anything happens. Power of attorney, also super important to make sure that you've got your medical power of attorney as well as a financial power of attorney. There's power of attorney is one sort of concept, and you can add a couple things onto it to make it a little bit different. And for the most part, what you will hear or see in your documents is what's called a durable power of attorney, which means a power of attorney that continues through your incapacity. So when you have a regular power of attorney, forget all the other words, just a power of attorney, you're essentially giving somebody the ability to act on your behalf for whether that's medical or financial. A regular power of attorney, you sign it into effect and it goes into effect today, right now. Then when you become incapacitated, it goes away. Now, if you make it a durable power of attorney, it will continue through and it will go away on your death. If you make it a springing or spring forward power of attorney, it will not go into effect until some determined event. Usually that is incapacity, which means that you would need a durable power of attorney that continues through incapacity with a springing provision or spring forward that only goes into effect when that happens. So the reason that that's important is so that if you become incapacitated, somebody needs to pay your bills or make something happen for you while you're in the hospital, unable to do anything, and you're not even there, you can't sign documents. Somebody can take care of that for you in the interim before somebody like a trustee would step in after your death to take care of situations. Yeah. 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 Usually it will be a spring forward durable. That is most of the time what you're getting. But it would be good practice to go read up and just see like when does this kick in? Because I mean, it is possible that if the person who created the document for you wasn't thinking about it too hard, you might have already given somebody power to act on your behalf and they just don't know it yet. So it's a good thing to check, but I'm fairly certain that you'll have a spring forward durable power of attorney. Interesting. Yeah, so that's something that's important for people to be aware of so that you can make sure that it actually gets followed.
So, the thing to do, the funny thing is, and you have a big estate, you want the same person deciding to pull the plug for the wall and inherit all the money. So sometimes you have a financial durable power of attorney where that person, just saying.
Wait, so am I both?
Yeah. I have different. But that's how we manipulate. When you get some PhD done, you sometimes run into problems with banks.
Yeah, so co-trustees is something you want to be careful with because when you have co-trustees, they need to agree. And they need to not only, yeah, so they need to also agree at the same time and they need to both be available. So we've run into a situation where we've got one, but the other one's out of the country, gone for who knows how long. And we can't do anything. We cannot fulfill the needs of the trust because that trustee is nowhere to be found and we can't get a hold of them. Mm-hmm. No, that's true. They don't have to be in the same place at the same time, but they do need to both be available to sign documents. So that's the important part.
And agree, 'cause the banks don't want to get in the middle of a family fight. That's why a lot of banks won't even take people to it. But it makes sense of honor and estate plannings.
Well, it does, if in this case, it's.
Yeah, and they get along and they, join.
Yeah. Sure.
Finding your trustee, one signature is enough. Yes, it can be
Hmm.
hard.
Sure.
Yep. Yep. What about it? Yes. Yeah. Yeah. So when courts get involved, this is what we're trying to avoid. This is why we like having transfer upon death. This is why we like having beneficiary designations. This is why we like having trusts. What we want essentially is we really want to follow this path. We don't want to worry about probate court. We want to go straight from the estate to the beneficiaries. Maybe it hangs out in the trust for a little bit, but we don't want to go through any other third parties before we get to the beneficiaries because we want things to happen smoothly, correctly, and not for a ridiculous fee. So if you don't have estate planning that takes care of this, you will have your estate go through the probate court, and then they will decide, based on some instruction you've left or lack thereof, how these are going to get distributed. And you can also, your beneficiaries can challenge that in court. They can come back and fight the judgment. They can fight the decision, say, well, I deserve that because blah, 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 and whatever. And even if that's not what you want, you don't have a say in it anymore because you're not there to fight for yourself. So if you are allowing the courts to do this for you, you might not get what you want. If things are simple and they're very easy to make happen, that's fine, but it's really important to have those beneficiary designations, transfer on death, and whatever else that you can just to make sure it goes smoothly. So why do we want to avoid probate? We talked about this a little bit last time, but in California, it typically takes 12 to 18 months. 12 to 18 months just for your beneficiaries to get their money because they take forever. I mean, it's California. If you've been to the DMV, you understand why this is very common. It could be really expensive. The fees are not based on a net estate after debts. They're based on the gross estate before they're paid. So it's a percentage of the gross assets that are getting processed through court. And it could be, I think, based on what I saw when I was researching these slides, it was like 3, 4, 5, 6% of the gross estate of everything. If it's half and half, you got $1 million, but $500,000 in debt, too bad, you're getting charged on the million. So that's really important to understand because those fees are based on gross assets. You want to make sure that you're paying the estate planners, not the courts. Probate proceedings are also public proceedings. Everybody gets to see what happens, where everything goes, and that might not be what you want, especially if you have, how do I say, better relationships with some beneficiaries than others, because that will cause a lot of problems. That will cause this whole process to get dragged out in court, and that could just not be what you want either. You don't want to create drama for people that you think you're helping, you know what I mean? And assets can just be distributed in a way you didn't intend. So, and pretty much anything can happen in those probate courts. A lot of it, if there's significant instruction, it might go maybe 70, 80, 90% of the way you want it to, but you always just don't want to take that chance, especially if you've got pretty grand ideas for how you want assets to be left down.
You guys remember the attorney that was the trustee for somebody's trust hiding behind the tree like the guy was trying to shoot him?
Oh,
Yeah, it's been a while. It was on the news.
yeah.
Yeah, so you wanted, the beneficiary, the attorney was managing all the money and siphoning it off for himself, legally billing it. And so then they showed, remember, on the news, this attorney's hiding behind the tree, that guy's trying to shoot him. Because he was so upset. Yeah, it's your stuff. You guys are too young to see that.
Yeah, so couple things, here's a couple things that you might be trying to do with your estate planning. So we talked about why you want to do all this planning and make sure that the wrong things don't happen. But here's a couple goals that you might be looking to fulfill with your estate planning. You might want to do some charitable giving. You can accomplish that with a beneficiary designation. If you want your IRA to just go straight to a charity, fantastic, you can do that. Same thing with individual accounts, checking accounts, all of that. You can do what's called a qualified charitable distribution. Oftentimes, this is when you have somebody who's super set up in their retirement, and now we get to RMDs, and they just don't really need the income right now. They can allow the portfolio to continue to grow, but they don't want the money that the IRS is requiring them to take. So they'll do what's called a qualified charitable distribution, or a QCD, and you can fulfill your RMD by sending that straight to a qualified charity, not have to take the money, not have to impact your taxes, and just keep living your life. Donor advised funds are also something that you can use if you need a current tax deduction, but you're not 100% sure where you want the money to go. I just did this with a client at the end of the year last year. So she wanted to reduce her taxable income for the year, and she wanted to start getting rid of some greatly appreciated securities that she had. She had a bunch of NVIDIA stock, and it was up crazy, like 300, 400%, something like that. and we wanted to give that money to a charity, but we didn't know where we wanted it to go yet. So I had her set up a donor advised fund with Charles Schwab, and we were able to transfer that stock to the Schwab account. She gets the full deduction for the current market value of that stock today. So she got the deduction for 2024, but she still gets to control how that's invested and gets to choose at a later time one of the partner charities of Charles Schwab to leave that money to later, and she can send that whenever she wants. So you get to move the money over to the donor advised fund, get the current tax deduction today, and then decide which charity it's going to go to later because they're holding it for the benefit of whatever charity that you want. Charitable trusts can be somewhat similar to a donor advised fund, but that's with a vehicle of your creation. So you can have something called a charitable remainder trust where you take your assets, put them in the trust now, you get the current tax deduction, but then you can take the income back out of the trust. So if you've got maybe dividend paying securities, real estate, whatever's in there, and it's generating income, you can keep the income benefit for your life or give it to whoever you please. Keep taking that income. Then when you pass, the remainder of all the assets in there goes to the trust. That's what the charitable remainder trust is. It goes to the trust after your death. A charitable LLC is it's kind of a confusing concept, but the idea is that you are wanting to put shares of a company or your assets inside an LLC that you've earmarked for charitable purposes. Then you gift your shares of the charitable LLC that are non-voting, as that's your tax deduction, but you're still maintaining all the assets. So if I put a bunch of real estate in a charitable LLC and I gift the charity the shares, they didn't get the assets yet. They just got like 99% of the representation of the assets, but I maintain the voting shares, the managing shares, so I keep working with the assets until some later date. It gets a little bit more confusing, and there's a lot of legal gray areas where you can be buying the shares back or taking loans on assets. It gets really messy really fast. Yeah. IRS wants their money. That's basically it. There's no other real reason that I can point to besides IRS wants their money, and they don't want you to keep leaving it to generation after generation after generation and then using like specific exemptions or something to take. They just don't want it to grow indefinitely. It's kind of like with trusts, you have to have a very specific type of trust that lasts for multiple generations many times over. And when you start gifting to generations that are further and further excluded from you, the tax consequences get worse. So it's kind of a similar thing than that. They don't want you to just infinitely compound your money forever. Inherited account, then it's 10 years. That's what the required, it's not really a required minimum distribution because there's not an annual amount. It's just within 10 years, it has to be distributed fully, right, if you inherit it. But if it's your account, you hit 73, the IRS uses the uniform lifetime tables, which is just saying you're probably going to live 24 years or whatever it is, right? And then they divide your account up by that. That's the amount you have to take out for the year. So it does. Yes, because the life expectancy shortens. So you have to take more and more. But oftentimes, you'll have plenty left at the end of it if you just take the RMDs. So it's not too much of a concern.
Take the funds required minimum and roll it into a Roth.
So,
if you want to roll it into a Roth, is that legal?
yes, but you need to make sure you have earnings because they don't count as earnings. That distribution doesn't count as earnings. Right.
I read 72, I got the requirement, I'm gonna pull that money out, but I don't know what to do with it, so I'm gonna roll it into the Roth.
Right. So if you pull it out of the account, in order to contribute it back into a Roth, you need to have earnings. So you need to be doing something for money. Yeah.
The actual
No.
RMD, you have to have earnings because it's like you're doing a new law, you have to have earnings. You can convert principal other than the RMD.
Oh, I see what you're.
Right. So you can't just convert the RMD over to a Roth account. Yeah. Yeah, that would be fantastic if I could be doing that. Let's see, moving on to inheritances. There's a couple different things. Obviously, your beneficiary and transfer upon death, same sort of thing. Give the assets straight to the beneficiary. Revocable living trusts, wills, and family limited partnerships are one thing that's interesting too, because oftentimes if you've got a family business, what you want to do is you want to start giving over your lifetime. You want to give your kids the limited partnership shares where they don't have control over the business. So you'll create a partnership where you keep the general partnership shares and you start gifting over time the limited partnership shares using what's called the annual exclusion. So there's a certain amount that we can gift to people, as many people as we want, every single year in perpetuity. Right now, did they increase it for 2025? It was like 18,000. Yeah, it was 18. I just don't know if they increased it, but it's $18,000 every single year. We can gift somebody without there being any gift taxes or reporting or anything. So we can do that every year to as many people as we want in perpetuity until we pass. And what people will do is they'll create the limited partnership and use that exclusion to gift the limited partnership shares to their kids over time so that all the limited partnership shares move away, but they maintain control because they have the general partnership shares. Yes, yeah. Yeah, and so the reason that most of us can use that without worry is because we're not expecting that the estate, when we pass, is going to be super large. So what you're doing essentially is when you gift over $18,000, it cuts away from that total number. So if you've got 13 million and I gift 1 million today, it's 1 million minus $18,000, cuts away at the 13, we get down to 12 and change, or 11 and basically 12. And so if you erode that all the way to zero and you still have a $2 million estate, now you're going to pay estate taxes on that. Well, because that's what you're going to use it for. That's what the exclusion is for. It's so that when you pass, there's a certain, like all of your assets, you're not going to pay estate taxes on them because the exclusion is so high. But if you eat the exclusion all the way down to zero, it's not going to apply to anything because there's none of it left. Then you pay estate taxes, which are another stupidly high tax rate. Yeah. So we don't have a state estate tax. There's just the federal estate tax, which I don't remember what it is exactly. It's really high though.
It gets up to like 40%.
Yeah.
But one of the good things for people that are not California is that we don't have estate taxes in the state. And our property taxes are off, and we have better weather, and we have better everything else. So people are not gonna, they go to another state thinking they got it made, their property taxes are twice as much, and now they have estate taxes.
Oregon is a 1 million.
Really? Yeah.
Over 1 million.
Yeah. So you'll
Yeah.
get, yeah.
Very low.
Exactly.
Yep.
Yeah. So be careful. Don't knock the state too much.
Money to somebody. You don't get it right off though. The person who's a gift, when you receive the gift, they don't have to pay the tax on it.
Depending on what it is. If you
Right.
retirement plan, they'll pay the tax.
Well, okay. So one thing I want to make sure that we clarify, we're talking about two different types of taxes. We're talking about both income taxes and gift taxes. What we're getting away from here is gift taxes. If we gift over a certain amount, we can either take it from our annual exclude or our lifetime exclusion amount, or we can pay the gift taxes, maintain that exclusion, and then some of those gift taxes add a little bit to the basis of the thing that we're gifting, but then there's still capital gains taxes or ordinary income taxes depending on the type of asset. So there's two different types of taxes that we're talking about. Gift taxes, which for the most part, none of us will ever worry about because 13 million should cover it, but income taxes will be there regardless. Yeah.
I'm sorry, that's true, yeah. Yeah, recipient, when I do give me $15,000, I'm not gonna pay tax on that at all. And I.
Right.
You've already paid taxes on it.
Yeah, potentially, unless it's an appreciated asset. Yeah. Yeah, but there's also, if we're in the case of an appreciated asset, if I gift somebody stocks that have appreciated a whole bunch, that tax, that's what the recipient's going to pay. That capital gains, they're going to pay that because I haven't sold it and captured that yet. So if I buy a stock for $100, now it's $1,000, that $900 of capital gains, I'm getting rid of that liability by gifting it. So if I gift it to the other person, they now receive that. When they sell it, they're going to be responsible for those capital gains still. Not when they receive it. Nope. So you'll have that. And then there's a couple different like double basis rules and a whole bunch of fun stuff when you get to gifting, but that's a more complicated tax code. Right. The other thing that you can have is what's called a special needs trust. Just really quickly, it's basically a trust with certain provisions that doesn't impact government benefits. So if you've got a special needs person who's getting assistance from the government, you can create a certain type of trust that only pays for certain expenses. Therefore, they still maintain the ability to receive their government benefits for the rest of their life or however long. In terms of asset protection, I mean, one of the most common things that younger people are talking about, your prenuptial agreements. It's important, even though they can sometimes get overturned in court, it at least gives you a chance, you know. Irrevocable trust, like we talk about, if you have that arm's length assets from you in the irrevocable trust, they're not available for creditors, like we talked about. Homestead exemption, just for living your primary residence, you get a certain amount of exemption for that that's not included in a claim. So I don't remember exactly what the California number is, but there's some, yes. Oh, fantastic. Yeah. 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 So there's a certain amount of your home to where if you get a claim, you get a suit or something like that, they can't take a certain amount of equity. Like if you have like a $500,000 house and you have $250,000 of equity, that's not enough equity for them to be able to take that from you. But if you have a really valuable house and you got like $1 million of equity, some certain amount of that is still going to be vulnerable and they could force you to sell your home. So another reason to have umbrella or homeowners, all those different types of insurance coverages to make sure in that situation you can keep your home. Yeah. Right. Yeah.
And the thing is,
Yeah, but you know about that too.
yeah, it used to be if you got in a wreck or something, you knew you were going to be sued, you could file a homestead for your house and protect 100,000 of equity. But they moved it up to like 600, 650. So that lessens the need for an umbrella if you've only got your one house at 600,000 or less. So that's the exemption there.
Primary residences count.
I think so.
Yes. Yeah. Obviously, also, we know that LLCs protect you a little bit. It kind of creates that if you have an LLC corporation or a limited liability corporation with multiple members, each member is only responsible for their own mistakes, and the company generally is responsible for its own mistakes. However, also be aware what state you're in, because in California, a single member LLC basically is void. You don't get any protection by having an LLC and it's just you, because the state will go, come on, it's just you running the business. There's no separation between the business and you. Therefore, that doesn't really matter. So that's important to understand. Okay, we're going to try and fly through a couple more of these slides in the next couple minutes, but we might have some more to talk about next time. Next, we have our tax diagnostic. So we want to make sure that you're taking advantage of current tax deductions, preferential tax rates, and tax-efficient investment products. So you can't just get out of taxes like we mentioned, but there's some places that you can go to get better preferential rates or maybe tax-free income. And are you properly prioritizing investment distribution sources, capital gain or capital loss harvesting, or charitable contribution sources? It's better to make a charitable contribution from a greatly appreciated asset, or even better yet, a ordinary income tax asset like an IRA, versus out of just straight up cash, because you don't have to pay the taxes on that. But if you do cash, you have a higher limit that you can do a charitable contribution. There's a lot of different factors there. So I pulled some deductible expenses from the IRS website. Here's a big long list of things that you can deduct when you take the standard deduction or you itemize. If you want to look these up, just look up deductible expenses on irs.gov and you'll see a nice big list. Okay, and then we've got another list of things. Oh, you want me to go back so you can take a picture? Here you go. All right. Next, we've got things that you can deduct if you itemize. So things that you'll be used to, capital losses with your maximum of $3,000 a year versus ordinary income, gambling losses to offset gambling income. So that's kind of nice. But you can't go beyond your gambling income. You can only deduct against the income. Medical and dental over 7.5%. All that interesting stuff. Home mortgage interest, which I'm sure you're used to as well. So yes. So there's a couple other tax efficient strategies that you can use as well, like tax advantaged investments, tax credit investments. So we're talking about like, Section 8 and other different sorts of incentive programs. Looking at mutual funds versus ETFs, we'll talk about this more when we get into the actual investment side, but there are tax differences between mutual funds and ETFs. ETFs tend to be much more tax efficient for growth assets versus mutual funds because ETFs exchange traded fund. So an ETF doesn't spit out capital gains like a mutual fund does, but we'll get into that way more later. Tax deferred annuities, if you've maxed out every other type of contribution you can do, or you just don't have other options, tax deferred annuities can actually be useful for that, but we don't often recommend annuities as investment vehicles. Tax deferred investment vehicles like your IRAs and 401ks, that's what we prefer to focus on first, then look at the annuity later if we need to. And then obviously Roth accounts are amazing for growth and for leaving to beneficiaries. So here's a little bit of a stair-step illustration that shows you if you just wanted to create a super efficient, super tax efficient investment program, you could start here. You could start with the tax favored money market funds, tax favored index or ETF income funds, so municipal bonds, tax managed growth funds, index, all the good stuff. You can walk all the way up that. It's great for younger people to do, though I would say for younger people, I would also be really biasing against those Roth accounts. Or biasing towards those Roth accounts, sorry.
The word tax favor, we wanted to say tax-free, money market, tax-free, mutual fund. Legal won't let us say it, so that's tax-free, place for tax. Yes.
Yeah.
Their Vanguard has a tax-free money market fund and things like that, and bond funds and all that.
Okay, so that brings us to our time today. We've got like 10 more slides that we can go over at start of next class. But one of the next things that we'll talk about is converting your IRA to a Roth IRA. So we'll start having that conversation next week, try and run through all of these before we start on our next set of slides. But that does it for our time today. And I appreciate you all coming and asking lots of questions. I love the engagement.